Hello, this is the first of 3 episodes of the Project Finance Primer, dealing with how lenders look at project risk and what makes a project bankable or not. Now, it's fair to say that for lenders, some risks are like an on-off switch. If they're uncomfortable with the level of risk in these areas, there is a good chance they won't proceed with a project. Other risk factors might affect pricing, the amount of debt that can be raised, and the other terms and conditions included in the loan agreement, but they rarely turn the deal on or off. These issues can be seen as more of a volume control rather than a binary on-off switch. You'll remember from primer number 5 the risk wheel that we showed to illustrate the risks that lenders typically consider. Well, the order in which those risks are shown in this wheel have been chosen carefully. We've grouped some of the key potential on-off factors, the on-off switches if you like, early in the wheel because it often makes sense to review those factors first. In this episode, we'll be looking at sponsor and equity risk, country and political risk, and construction or completion risk in a bit more detail. These are very important bridges which lenders have to cross long before they start looking at financial models. Let's look at sponsor risk first. Many projects have fallen at the first fence because lenders could not get themselves comfortable with the strength and track record of the sponsors. Repayment of project debt will come principally from cash flow, but lenders will want to be satisfied about the general creditworthiness of the sponsors. After all, if the sponsors collapse during the construction period, the lenders will have a problem too. Lenders like to work with experienced sponsors who've developed similar projects before. This makes life more difficult, of course, for startup sponsors, but track record and experience definitely boost lender confidence. Debt providers will also want to be confident that the sponsors can inject their equity when that money's needed. If they have concerns about the sponsor's ability to inject equity, they may well insist on the sponsor's equity being spent first, before the debt is drawn. With stronger sponsors, lenders are usually happy for the debt money and the equity money to be spent side by side as the project is built. With really strong sponsors, lenders might well allow their debt to be used first. Sponsors will normally want their financing to be non-recourse during the construction period. In other words, once they've injected their equity, the lenders cannot require more funding if something goes wrong. But if one or more of the sponsors is weak, lenders might insist on some form of pre-completion support. For example, a stronger sponsor might be asked to guarantee the obligations of a weaker sponsor. Let's move on to country or political risk. This is an issue which can have a very strong influence on where the financing for a project comes from. The financing buckets, if you like. Lenders have to face the risk that the project they're financing could be expropriated, confiscated, or nationalised by the government of the country where the project is located. A war, a civil war, or a period of civil unrest could stop the project operating. New taxes could be imposed, affecting the net cash flow generated by the project. If the project generates revenue in local currency, but has to make its loan payments in another currency, like dollars or euros, then exchange rates can have a major impact on cash flow, either positive or negative. But of course, it's the negative impacts that lenders tend to worry about. To keep their levels of exposure within safe limits, lenders will create country limits for themselves, which will go up and down as country risk increases and decreases. Commercial banks have particularly tight country limits for emerging markets, so it may be difficult to find a group of banks to finance a particular project in an emerging market, even though the project fundamentals themselves are very strong. Country risk can sometimes be managed using insurance packages, but this type of risk is most commonly mitigated by bringing in export credit agencies and multilateral agencies into the financing group. Turning now to look at risk factors inside the project rather than outside, we come to the construction period. The time from construction start to project completion is a period of great risk for the lenders as well as the sponsors. The project is not generating cash flow. It's taking on more and more debt. It's adding the interest on its loans to the loan balance because it has no cash with which to pay interest. Naturally enough, lenders will want to reduce uncertainty as much as possible during this period. They will favour well-known, experienced contractors. They'll also have a strong preference for single-point responsibility. What do we mean by that? Well, what we mean is that lenders will prefer to have a single contractor, or if there's more than one contractor, they'll want to have one of the constructors take responsibility for building the whole project and wrap the other contractors, if you like. Lenders will also have a preference for fixed price, turnkey construction contracts, otherwise known as engineering, procurement and construction contracts, or EPC contracts. This type of contract is not the most common form of contract, and it's likely to be more expensive than the other options. But lenders, of course, are far more interested in certainty than they are in price. Lenders will not, of course, simply rely on the words fixed price turnkey contract. They are going to drill down into the detail of the contract and carry out a very careful analysis of the rights and obligations of the parties. Once again, if they feel that the construction package is weak, they will be likely to ask for more support from the sponsors during the construction period, making more holes in the non-recourse wall. So what have we learned? In their review of a project, potential lenders are likely to focus on equity, political and construction risk at an early stage, because these can be limiting factors on the project's bankability or even on-off switches. It's very important for sponsors to review these areas in detail, to anticipate the questions which are likely to be raised, and to have their answers ready before they make their approaches to lenders. In the next episode, we'll look at two more project-specific risk issues which can affect bankability: supply risk and offtake risk.